Well, good morning and welcome. You're watching ET Now, and this show is called Market Cafe. I'm Harsh Saita. With me is Snehi Shah. Over the next hour or so, we'll give you a quick catch up on what y'all have missed over the last 12 hours or so. And of course, we'll also give you a lowdown on how global markets have closed. So let me start off with that first, how our Q's looking. And before we look at the overall Q's, let's look at how global markets are doing, Sneh.
Absolutely, Harsh. Good morning, and wishing all our viewers also a very good morning today. Let's kickstart the global handover by looking at the US markets then. And the US stock futures ticked up on Wednesday night as investors look towards new consumer inflation data for greater insight on the economy. Now, when you talk about the trading intraday session yesterday, the major averages closed Wednesday's main trading with modest gains, marking a fourth consecutive winning session. Now, the Dow was up 0.2%, S&P 500 added almost 0.5%, and Nasdaq also climbed 0.7%. And a key to note here is the Nasdaq closed above its 50-day moving average for the first time since September. So, well, that's some positivity that you can see on the Nasdaq. The consumer price report for September will be released on Thursday morning. Economists surveyed by Dow Jones are forecasting a 0.3% month-over-month increase and a 3.6% increase when it comes on a yearly basis. Investors are believing that the strength of inflation indicated in the report will play a key part in whether the Federal Reserve decides to maintain or raise interest rates at its two-day meeting, which begins on the 31st of October. The data comes following a stronger than expected producer price index for September. Traders will also be keeping an eye out for jobless claims numbers on the week ending October 7th. Now, several companies will kick off the latest earnings season on Thursday. Delta Airlines and Walgreens Boot Alliance will release their results before market opens for the day, before the US markets opens, that is. Fastenal and Domino's Pizza are also scheduled to post their quarterly earnings. So, well, this is what the handover from Wall Street is looking like. Largely in the green, all three indices holding on to some nominal gains. Shifting focus to Europe, then European stock markets closed higher on Wednesday morning after clocking their best one-day performance in nearly a year in the previous session. Stock 600, that's the index to watch out for, that ended with an uptick of 0.2% higher after a choppy morning. So some recovery was seen when it comes to the stock 600. Food and beverages stock rose almost 1%, while retail stocks fell 2.1%. Now, what brought about this fall in retail stocks? Well, you've got Louis Vuitton, Moet Hennessy, which is LVMH, which is the world's biggest luxury firm, that reported a slowdown in growth, and that was bigger than what the street had penciled in. Shares fell as much as 6% as the results pulled the wider luxury sector lower. FTSE was also down almost 0.1%. DAX was up 0.2%. So largely flat when it comes to the European markets, but positivity when we look at Wall Street. But Harsh, this is on the equities front. Take us through what oil and other commodities have done.
Well, yes, let me first start off with oil. Interesting moves coming in with regard to oil. You know, the spike in oil prices at the start of this week has now tempered. In fact, oil has fallen 2%, on the back of the fact that the Saudi has suggested that they are trying to mediate with regard to the conflict between Israel and Palestine. And they're going to try and resolve that, is what Saudi continues to suggest. Of course, they've assured that they will ensure stability in the oil market, and therefore what you are seeing is that reaction of comfort coming in with oil prices sinking around 2% or thereabouts. Also, when it comes to growth, there are some concerns. You have Germany, which is expected to experience a bit of a slowdown, in fact go into a recession of around 0.5% or thereabouts. That should also aid oil prices, because that slowdown should essentially mean that consumption will take a little bit of a hit, and therefore you're seeing a little bit of a tepid pricing with regard to oil. So oil has fallen 2%. Of course, positive when it comes to Indian markets, because we import most of our oil. Current account deficit is helped as well. CPI it aids the CPI numbers as well. So at the moment, it looks like a positive sign, at least for India. Snehi.
Absolutely, Harsh. Oil is cooling down. With that, let's also take a look at all the important cues that you need to be keeping on your radar for today's trading session. And let's start by looking at some macro cues then. When it comes to India, you've got the IIP as well as the CPI data coming in. For US, you've got the CPI as well as the initial jobless claims data coming in. And for the UK, you've got the IIP data. So while a slew of key macroeconomic indicators, watch out for all of these indicators when it comes to today. And let's shift focus back to home then. And TCS kicked off the earnings season yesterday, but then you've also got two major IT companies that will be posting their earnings today, that is HCL Tech as well as Infosys. When it comes to the non-Nifty pack, you've got a bunch of companies that will be posting their Q2 numbers, the likes of Angel One, Anand Rathi, HDFC AMC, Tata Metallics as well as S&W Renewable, that's Sterling and Wilson. Then you've also got JTL Industries as well as Kesoram Industries that will be reporting their numbers today. When it comes to corporate action, then the lock-in period will end for 50% equity for Avalon Tech. So that will be another stock that will be in focus. And when it comes to other events, then you've got the ECB that will be publishing the account of September policy meeting today. So keep an eye out for all of these indicators.
Right, all of those indicators in focus. Also, I'd like to flag off, you're looking at the US 10-year bond yield, which has fallen quite sharply. So we saw the US 10-year bond yield at 4.65% yesterday. It's come off those highs, come in at 4.57% now. So you've seen around a 7 to 8 basis point retreat versus yesterday morning, around a 4 to 5 basis point retreat post-close yesterday, which is decent, when you see it, and that would also have aided equity markets. So that's one piece of it. You're also seeing the dollar index largely stable in trade. So you're seeing the dollar index at around 105, and despite that, you're seeing oil prices sink 2%. So that's something that one needs to note. Also, the other last piece is with regard to alternative asset classes like gold. You're looking at gold at $1,890 an ounce. You're seeing a bit of a spike when it comes to gold as well. There's a 1% spike coming in there versus yesterday. So that's how you're looking at the other asset classes with regard to bonds as well as gold. Keep an eye out for that. But let's quickly move on. Let's move to geopolitics, which has been in focus this time around. You're seeing conflict which continues to intensify in Gaza, and Israeli Prime Minister Benjamin Netanyahu vowed to destroy Hamas following its surprise attack. Global and regional leaders continue efforts to end the ongoing escalation of war. Military forces continue to pound the Gaza Strip, killing as many as 1,100 Palestinians, while the death toll in Israel has climbed to 1,200 people. Palestinians in Gaza continue to suffer as the only power plant remains out of service due to a lack of fuel. Germany has joined the US in providing military aid to Israel, allowing Israel to use 2 of its combat drones. Earlier, Netanyahu and opposition leader Benny Gantz announced an emergency government and a war management cabinet to exclusively address the ongoing conflict with Gaza, refraining from advancing any unrelated policies or legislation during this critical period.
And meanwhile, back home, External Affairs Minister S. Jaishankar has launched Operation Ajay to bring Indian nationals back from war-torn Israel. Special charter flights and other arrangements are being put into place.
Right, and staying with the war and the impact of it, US Treasury Secretary Janet Yellen has said that the unprecedented attacks on Israel have posed an additional risk to the already tepid global economic outlook. However, she says that the US is still headed for a soft landing. Meanwhile, IMF chief Geeta Gopinath said the war could hit the economy if it expanded, causing oil prices to go up, which could depress global output ahead.
And social media platforms continue to be on the radar of the European Union. After Musk, now Zuckerberg has received a warning over the spread of disinformation on Meta. Zuckerberg has been given 24 hours to respond and comply with the European law, and the letter asks the Meta owner to produce details about proportionate and effective measures taken to counter the spread of disinformation.
And the war doesn't just affect people, it also affects businesses. And the ongoing war between Israel and Hamas have affected trade businesses. India exports both big as well as small diamonds to Israel at great value. So how will this war impact India's trade? My colleague Sumita Karir explains this in a special report.
$1.2 billion. That's the value of diamond exports from India to Israel. In FY 22-23, the total gems and jewelry trade between India and Israel stood at $2.04 billion, which is a decline from $2.8 billion recorded in FY 21-22. So, will the ongoing Israel-Hamas war take the sheen off the diamond sector in India? While impact assessment of the war at this point is premature, say experts, while being in cautious mode. Vipul Shah, the chairman of the Gems and Jewelry Exports Promotion Council, says, and I quote, "We are all concerned and hoping things don't escalate and get resolved soon. The industry is on a cautious mode." Colleen Shah of Kama Jewelry says India may not see an immediate impact due to trade relations with other entities such as the ASEAN body. However, in the long term, if the war does prolong, this could affect the industry adversely. The war situation will further intensify the blow to the trade between Israel and India. So while it looks like the ongoing war could have some short-term impact, but industry experts say a long-term disruption is unlikely provided the war doesn't escalate into a regional proxy war.
Already I told you in the far size already 20-25% diamonds are on a downside. There will be not much of impact in India of this war because our exports are not even more than 10%, including diamond, gold, and everything to Israel. And the best part is that our exports are there only in far size diamonds that you can say 2 carat, 3 carat, 5 carat, and up. So only big diamonds are exported there. Definitely there is a short-term impact because you can see in the Middle East there will be big fluctuation in the currency.
Even in terms of price fluctuations, experts say that since exports have already been muted, import of raw diamonds is on a pause for 2 months. A major impact, hence, is unlikely.
COVID, the spike of the price in diamond was 70 to 80%. In small diamonds also, that is, the small diamonds are called as star, melee, plus 11. These are the small diamonds. There was the spike of 70 to 80%. At the same time, in the solitaires, that was a spike of 80 to 90%. So from 90%, they have come down to 20-25%. And in this, but the interesting part is this, in small diamonds, star melee diamonds, the spike was 70 to 80%, but the downfall is not more than 3-4%, 5%.
Glitter of a diamond can easily outlast nature's worst. But can its value and demand sustain the disruption caused by a war? Well, that remains to be seen. In New Delhi, Sumita Karir for ET Now.
Alright, that's the India's diamond trade in focus on the back of the war. But let's get a move on then. And shares of German sandal maker Birkenstock tanked after the company notched a valuation of $8.32 billion in its market debut after shares opened 11% below their offer price. The stock opened at $41 a piece versus the issue price of $46.
Right, and switching focus, Filmfare hosted a roundtable event in collaboration with the government of Gujarat and key filmmakers from the Hindi film industry. Vineet Jain, the managing director of the Times Group, is spearheading this initiative. In attendance were Chief Minister of Gujarat, Bhupendra Bhai Patel, and Minister of Tourism of Gujarat, Mulubhai Bera, as well as other key policy makers and officials from the government of Gujarat. And at the sidelines of the event, my colleague Aishwarya Patil spoke with filmmaker and director Imtiaz Ali, Ashwini Iyer and Nitish Tiwari. Take a look at that conversation.
I think the key highlight was the earnestness with which the Gujarat government presented the policy and presented more than the policy, its intention to engage with the film industry of Bombay and make Gujarat a part of their movies, of our movies. The earnestness was very touching. There are many things that are good in the film policy that they have. They are also looking at their own cultural heritage in a way that is going to be positive for cinema. That is good. But I think there is also a sense of accessibility with the government. So when filmmakers go to a place, they feel the government can be a problem for them. This government seems like the solution for them. I think that was my key takeaway from this meeting.
For your next few films, will you consider Gujarat as the destination for filmmaking?
I mean, there is an opportunity and a issue over here as far as Gujarat is concerned. It's one of the states that I have traveled least in. I have to admit that I don't know many things about Gujarat, but I'm therefore also eager to go there and to see the place. I'm sure that the people are I have always had very good experience working with Gujaratis per se. So I'm sure that the people, the workforce will be very good and progressive and participative over there. But as far as the locations are concerned, I'm looking forward to going there on my own and having a look. And hopefully I will be shooting there soon.
One final question. This is a precursor to the film fair. What is the one thing that you really look forward to at the Film Fair Awards?
I look forward to the hosting, the bonhomie of the film industry, because it's an intimate event, the film fair. It's not... so the film industry is kind of present in one room all together, and there's a feeling of great bonhomie. It's almost like a family sitting together.
Anything which encourages storytellers to go and start exploring different kinds of places, because what happens is in our country is that we're so rich with our culture, with our textures, with our roots, and with the characters, that we can go every 500 meters and we'll find something different. And if Gujarat is giving us that kind of opportunity to explore a different kind of map in terms of textures and colors, and also the kind of facilities they're giving us, I think it's great to at least explore the possibility that next time when you're going on to the paper, you say that film opens in Gujarat, so in a small town in Gujarat. I think that would be nice to do.
There are a lot of situations and which are like non-specific. Now that is where I, as a filmmaker, is always looking for something which has not been seen before, something which has not been done before, something fresh which I can present to my audiences. So I would be more interested, because any location which is specific, you don't have an option but to go and shoot there. But for a non-specific situation, I am more interested in going and exploring. What is reassuring is that there is a line production support, there is a location manager support, there is government support. There is single window clearance and stuff like that, which is also very heartening to know.
All right, an interesting chat that Aishwarya had with prominent filmmakers from Bollywood. But with that, it's time to slip into a very short break. When we return, we'll take stock of how the Asian markets have opened up, so stay tuned.
Good morning, welcome back. You're watching Market Cafe on ET Now. Let's take quick stock of how Asian markets are doing early off in trade today. Are seeing gains on the Shanghai around two-thirds of a percent higher as we speak. Let's also have a look at the Hang Seng and close that 1% plus higher on the Hang Seng early off in trade. In fact, 1.5% plus on the Hang Seng. So positive there. Let's look at the Nikkei. In fact, all indices trading in the green as we speak. So the Nikkei is up a solid 1.35%. And that's again a positive. Let's also look at Kospi, which is up nearly 1% as well. So across the board, you're seeing good green, and the SX 200 also up around 0.25% or thereabouts. So you're seeing a solid carpet of green for a second consecutive day, or a third consecutive day. I would want to change that for Asian indices, and hopefully the Nifty also continues its similar upward trend. At the moment, the implied open absolutely flat, but that has been the case over the last couple of days as well, after which really it's gathered some steam post open. So let's hope for the same, Sneh.
Absolutely, Harsh. But let's shift focus back to the Fed Reserve for a minute. And when it comes to the US, we will be getting some key inflation data today. But Federal Reserve officials differed on whether any additional interest rate increases would be needed. Though the balance indicated that one more hike would be likely. And while there were conflicting opinions on the need for more policy tightening, there was unanimity on one point, and that is that rates would need to stay elevated until policymakers are convinced that inflation is heading back to 2%. These are, of course, the key takeaways from the Fed's September meeting. Hi there, welcome back, and thanks so much for staying tuned to Market Cafe. This is ET Now. Let's shift focus to the major earnings that the street saw yesterday, and that was from TCS. It was a mixed bag coming in from TCS with a miss on the revenue but a beat on the margin and the PAT. But strong order booking and margin resilience keeps the outlook for FY25 strong. My colleague Anisha Jain, who tracks the sector closely, is joining in with the highlights on the phone line. Good morning, Anisha. Please break down the numbers for us.
Hi, good morning. Yes, I think you perfectly summarized the earnings because it's a completely mixed bag. The miss actually came in on the revenue bit, wherein there was a decline when it comes to the dollar revenue, and this is the first time that we have seen that since Q1 FY21, which was basically a COVID era. But barring that, in the last many years, I haven't seen a decline, at least on the dollar revenue front. On the constant currency basis, the company managed to report a meager growth of 0.1% sequentially, but a big miss versus the expectation of around 0.6% growth thereabouts. The second miss actually came in with respect to the North America entity as well. There we have seen that the growth was very paltry at 0.1%, and that continues to be a weak spot. To add to that, the headcount also declined by almost 6,333 number. So that's a big decline that we have seen in terms of headcount. And of course, headcount is one of the metrics to tell you what the management is thinking about growth going forward and capability going forward. And that is a bit of a red flag. Having said that, there are positives in the earnings as well. Of course, the margin was a big beat versus expectation. 24.3 was a solid beat versus the expectation of around 23.6%. And going forward as well, the management commentary did point to the possibility of further improvement from here on. Additionally, the deal wins at $11.2 billion was very strong. In fact, the second highest that we have seen on record. And despite the closures happening, the management says that the pipeline continues to be quite strong. So that's another positive coming in. UK is another vertical that has stood tall for them, 11% growth almost on a year-on-year basis. Net-net, we have seen from the brokerages as well, there hasn't been a major cut or a major increase. There have been EPS cuts to the tune of maybe 1 to 2% and meager adjustment to their stock price as well, because the street has pretty much factored in that FY24 is going to be pretty much a washout year. There is no recovery certainty in the second half of the year as well, but the order bookings that we have seen is giving you more confidence about FY25, and hence they're more optimistic about that. But for the near term, the valuations will be a bit capped on account of the near-term uncertainty. But this is not a result wherein people will throw in the towel or sell the stock, and this doesn't give you the reason to buy the stock as well. So pretty much status quo. Back to you.
Thanks for that, Anisha. Status quo is her verdict on this one, but let's also listen in to some management commentary that came through yesterday. Let's listen in to what the management had to say. Of course, the management is going to be live with us at 8:25, but in the meantime, have a quick look.
See, to some extent it's broad-based, but we've been explaining it last quarter also. Okay, the trend is same. Essentially, clients want to invest in newer technologies. So technology adoption is very high, and given the macroeconomic uncertainty, there is also a lot of request towards cost optimization projects. So we are able to sign new projects, and the project that we sign, we continue to execute them, and they yield the revenue as planned. But in any given quarter, there will always be some amount of degrowth. Essentially, some projects will be complete, they come to a natural end, and some projects will get downsized. So if the degrowth is much stronger, or usually in a regular good growth quarter, there will be less of degrowth and more of new addition coming in. So net-net, you see a lot of growth. But what's happening now is that we are not fully compensating for the degrowth, which is more normal process. But we are not fully compensating because clients are also optimizing or pausing some of the ongoing projects, and so there's some deferral happening. So that's the reason why you see, while the TCV is still strong, the revenue growth is not reflecting in terms of sectoral, like while BFSI returned to positive growth, it's a small positive growth. I think I don't want to read too much into it. UK continues to be our, if I go through the industry verticals, manufacturing is one actually been performing very well, and energy resources has been doing well. Actually, one thing of interest is all our regional and emerging markets are doing very well. Middle East, Africa, India, or banking platform, they are all doing very well. Banks and banking platform, they are all doing very well. And if you look at geographies, UK continues to be a outperformer for us. And again, on a positive note, Europe has turned positive.
We have hired a large number of people in the last 3 years, and for most of the period they were working in hybrid/virtual mode. We strongly believe that they need to come to work so that the new workforce get integrated with the larger workforce of TCS, and that is the only way they will learn and understand and internalize the TCS values and the TCS way. Having said that, so yes, we are asking people to come all days in a week. Having said that, we will continue to assess the work models and evolve depending on what works best for our customers and our employees.
Alright, that's the word coming in from the management of TCS. We will be connecting with them live in a very short time. But moving on, let's track the mutual fund activity for the month of September. Where have the mutual funds added exposure? What did they buy and what did they sell? Somit is joining in with more details on that. Somit, take it away.
Well, if you see in the month of September, mutual funds have deployed close to 13,860 crore rupees in the Indian secondary market. Now, this amount is lower compared to what they did in the previous month, close to 20,130 crore rupees. But if you remove the NFO amount, then the inflow amount, the drop in inflow is a bit lower compared to what it is, including the NFO amount. Now, ex NFO, the inflow stood at close to 11,350 crore rupees. Now, the cash levels for mutual funds have also come down a bit from 4.8% that we had seen in the previous month. It has come down to 4.6%. Now, sectors where mutual funds have added more exposure are in utilities, metal and telecom and media, and the sectors in which they have reduced exposure are financials, agriculture and chemical companies, and also in IT stocks they have reduced their exposure. Now, coming on to stock specific, among large cap, Zomato remains the most bought stock for the second consecutive month for mutual funds. Along with this, the weakness that we have seen in the share prices of ICICI Bank, mutual funds have utilized this opportunity to add more exposure towards ICICI Bank. Apart from that, there is Power Grid, HL and Adani Power, which they have added to their portfolio. In sell side, if you see, despite the 17%, also in the buy side, if you see, despite the 17% rise in Adani Power's share prices, mutual funds have continued to buy this counter. On the sell side, if you see, SBI remains sell for the second consecutive month. Apart from that, PNB share prices were up nearly 27%, and mutual funds have utilized this as an opportunity to exit this counter. When it comes to mid-cap space, Vodafone Idea, REC and NMDC gained more than 20% in the month of September, and despite that, mutual funds did not shy away from adding more stocks, more shares from these counters to their portfolio. IRFC is one stock that gained more than 50%, and mutual funds have utilized this as an opportunity to exit this counter partially in the month of September. Apart from that, NHPC and IDFC remain sell for mutual funds for the second consecutive month. And lastly, when it comes to the small cap space, despite the 17% run up in SJVN, mutual funds have still added more shares in this counter. They have also added more shares in the Burger King operator, that is Restaurant Brands, RBL Bank, EMI, that is Electronic Marts India, and in IRB Infra. And when it comes to sell rating, GTL Infra stock ran up more than 50%, and mutual funds have utilized this as an opportunity to exit this counter. They have also sold NMDC Steel, Suzlon Energy, Chambal Fertilizer and Ujjivan Small Finance Bank in the month of September.
The buys and sells from mutual funds. Thanks for that lowdown, Somit. But stay with us. Grasim board will consider fundraising in its meeting scheduled on the 16th of October. The company aims to become profitable, or rather the number 2 profitable company in the paints market. Somit, break down the details for us. What does this mean?
Well, Grasim yesterday post-market announced that they will be looking to raise funds on October 16. Now, what the street is assuming here is that post the fundraise that Grasim does, they would like to infuse, or they would look to infuse funds in Vodafone Idea, in which they own close to 6.8% stake, because as we all know, Vodafone Idea is in dire needs of fund, and they have already, board has already approved a fundraise of close to 15,000 crore rupees. But what actually Grasim will be doing here is that they are looking to raise this fund to fund their capital expenditure requirement when it comes to the paint business. Now, Grasim has categorically stated that they would not be putting in any or infusing any funds in any of the group companies, including Vodafone Idea. Now, this is as per few analysts to whom it now spoke, and they have confirmed this with the investor relation teams of Grasim. Now, Grasim aims to become the profitable number 2 player when it comes to the paint business, and they have outlaid a capital expenditure plan of close to 10,000 crore rupees for their paint business going forward. Now, Grasim wants to strengthen the balance sheet because the debt is going to increase given the fact that there will be more capital expenditure coming in for the paint business. Now, management expects their peak debt to be in the range of around 8,000 to 10,000 crore rupees by FY26, as against a current debt of close to 3,510 crore rupees that we had seen in the first quarter of FY24.
Alright, Samit, thanks for taking us through that. Grasim will be a stock to watch out for in today's trading session. Let's move on to an ET Now exclusive then, and let's talk about the troubled airline Go First, because that airline has received an expression of interest from Jindal Power. We're getting word from our sources that the final bid will be submitted after evaluation. My colleague Ankur is here with all of those exclusive details. Ankur, over to you.
Yes, Go First insolvency likely to have entered final round, as we understand through reliable sources that Jindal Power has submitted an expression of interest for acquiring the defunct airline. Sources also say that Jindal Power has been selected as prospective resolution applicant for acquiring the company. Now, this means that Jindal Power may get access to the data, to information, and it may evaluate whether or not going ahead for the final bid based on the financial, based on the data which is accessed by the company. Apart from that, there were 2 more bidders who had submitted expression of interest, but lenders have chosen only one prospective resolution applicant for acquiring Go First. Remember, lenders had earlier extended the deadline for submission of EOIs as there was no proper response from the bidders, but now Naveen Jindal owned company which is Jindal Power has submitted the EOI for company, and it needs to be seen whether or not there is a final bid submission which happens for Go First airline. Remember, the lenders are looking to resolve a debt of close to rupees 11,600 crore, and this is only for financial creditors, and Bank of Baroda, Central Bank of India are lead creditors here.
Right, thanks for that, Ankur. But we'll slip into another very short break before we move to stock-specific news and action. So stay tuned on that one.
Hi there, welcome back. Thanks so much for staying tuned to Market Cafe. Now we're being joined by my colleague Ashesha to take you through a list of all the important stocks that could be potential buzzers in today's trading session and the ones that you should be watching closely. Ashesha, take it away.
Well, yes, a whole host of earnings candidates will be in focus today, and apart from TCS, we had a couple of counters which reported their numbers yesterday post-market hours. First up, let's talk about Delta Corp. Largely flat set of numbers. Revenues stood at about 271 crores, flat on a year-on-year basis. Margins, meanwhile, were also flat. They came in at 37% versus 37.2% same time last year. But management commentary with respect to GST implication is very important. The management said that 2 harms, remember, had received GST demand to the tune of 5,100 crores, and the company said that they will not be making any provisions for investment in the 2 arms until the issue is resolved. So the management commentary is quite important with respect to GST provisioning, although the numbers look largely flat on a year-on-year basis. Signature Global, meanwhile, weak set of numbers over here. Revenues have declined by a whopping 69% on a year-on-year basis. On the bottom line, the company has reported a loss of 7 crores. versus a loss of 32 versus a profit of 32 crores last year. So across all parameters, Signature Global has reported weak set of numbers. Aurobindo Pharma meanwhile will also be in focus today on the back of their biologics CMO foray, where the company has also signed LOI with Merck, and they said that they will be finalizing this LOI by March 2024. Analysts believe that this creates growth engine for the company, and hence it is a positive news flow. Aurobindo Pharma on the back of this will be in focus today. Also keep an eye out on Samhi Hotel. Again, a weak set of numbers for the quarter gone by. Revenues although have risen by about 13% on a year-on-year basis. Company has reported a loss of 83 crores in the quarter gone by. Weak set of numbers, keep an eye out on this counter as well. Lastly, Sula Vineyards, a strong set of operational data for the quarter gone by, where revenues grew by about 11% on a year-on-year basis, and own brands revenue also grew by about 14% on a YOY basis.
Right, thanks for that, Ashesha. Stick with us because Morgan Stanley has come out with a note on steel. Guarded view on the sector, doesn't see much expansion in spreads over the next few months. So talk to us about individual stocks, what the Morgan Stanley stance is, all of those metrics, Ashesha.
Well, yes, steel companies will be in focus today on the back of this Morgan Stanley report, and they believe that the stocks have run up quite a bit in the last few months, and despite that, they continue to remain cautious on the sector. Unattractive valuations, higher supply than demand, and uncertain macroeconomic environment is what makes them bearish on the counter. They say that they don't expect any material expansion in spreads from here on. China remains active in the export market, and hence Indian exports continue to remain under pressure. So their stance is very cautious on the entire metal sector. For Tata Steel, they've maintained their equal weight stance. They've hiked the target price marginally from earlier 110. They've hiked it to 115. For SAIL, they're maintaining their equal weight stance on the stock, but they've cut their target price to 80 from their earlier target price of 85. For JSW Steel, they're maintaining their underperform highs. They've hiked their target price to 585. And for JSPL also, they've maintained their underperform stance on the stock. They've hiked their target price marginally from 460. They've increased it to 500. Largely, they're maintaining their cautious stance on the sector. Unattractive valuations and unattractive global macroeconomic environment is what makes them bearish on the counter.
Well, thanks, Ashesha, so much for taking us through that. Let's shift focus to IT then, because Infosys is all set to report its Q2 earnings. What can you expect from these numbers? Anisha is breaking that down for us.
Well, yes, after the last couple of quarters of disappointment coming in from Infosys, the expectation is that on account of the low base, the growth will be stronger this time around. We're expecting a constant currency growth of around 1%, maybe 0.9 or 1.1%. That's the broad range that analysts are working with. The rupee revenue is expected to come at 38,350 crore, and the dollar revenue is expected to be close to $4,660 million. There is going to be an expansion on margin front as well, given that the company seems to have deferred the wage hikes here also. So we are expecting a positive impact on account of that. Plus the profitability is expected to jump up by around 3.5 to 4%. The deal ramp ups for some of the deals have been a bit delayed. The company had talked about last quarter how there have been client specific and vertical specific slowdowns that had been impacting them, especially in the BFSI, media, communication verticals, high tech as well. What's the commentary going forward? Is there any improvement or the situation continues? And also the new deal wins that the company has signed, which will mean that deal win in this quarter will be strong. But when does the ramp up start of that? And will H2 will be materially better than H1 or not? Will FY25 deliver a double-digit growth? These are the questions that we would like some answers from the management. In terms of other details, headcount trend is also something which is important because that tells you the kind of confidence the company has with respect to growth prospects. Of course, the attrition at higher levels has been quite high for Infosys. So let's see what the company delivers, both in terms of numbers as well as management commentary.
Right, thanks for that, Anisha. But with that, we're completely out of time on this edition of Market Cafe. The market will take the action forward. Thanks so much for watching.
Tata AI